Hello, fellow compounders. Dividends don't matter. Did you know that whether or not a stock pays a dividend really doesn't matter? Dividends don't increase your net worth. Profits do. Dividends don't make you more money. Receiving dividends is the same as moving money from one pocket to the other. And yet, many people prefer to invest in businesses that pay dividends. Why is that? In this video, I'll explain 3 things. Number 1, why dividends don't matter or shouldn't matter. 2, why dividends do matter to most investors. And 3, if dividends don't matter, what does? So let's get this out of the way. This video is for educational purposes only and should not be considered financial advice. I am not your financial advisor and you are responsible for your own financial decisions. Okay, let's get back to business. Dividends are money or stock distributions that a business pays its shareholders. They're usually paid out of profits that the business earned and are usually paid out quarterly. Not all businesses pay dividends. Mature companies usually do, while younger companies don't. This is because mature companies aren't able to reinvest all their profits, while young companies are in growth mode and usually have many more options to invest the profits back in the business. So let's get to point number 1, why dividends don't matter. Let's imagine that you own shares in a donut shop company, Dave's House of Donuts. The business is in its early stages and only has 50 donut shops. Let's say that each donut shop earns a net profit of $200,000 per year, and each new shop will cost $1 million to build. So at the end of the year, the business has a profit of $10 million. For this exercise, let's assume that you own 100% of the shares. The balance sheet at the beginning of the year looks like this. It has $5 million in cash for working capital and $50 million of assets worth of stores. That is 50 stores at $1 million each. And it has no liabilities. So the company's net worth is $55 million. And since you own 100% of the shares, you own $55 million worth of Dave's House of Donuts. At the end of the year, Dave's House of Donuts had a net profit of $10 million, which appears in the bank. So it would have assets worth $65 million. That is $15 million in cash and $50 million worth of stores, making its net worth at the end of the year be $65 million. Let's say that your entire net worth is your ownership in Dave's House of Donuts. Does it matter whether the business pays out a dividend or not? Let's do 2 scenarios to analyze this. Scenario A, no dividends are paid. This means that your net worth is $65 million because you own 100% of Dave's Donuts, which is worth $65 million. Scenario B, the business pays out all its profits, the $10 million, to you as dividends. So assuming that you don't pay any taxes because it's in your Roth IRA, you would end up with $55 million worth of Dave's Donuts because now it's worth $10 million less. It has $10 million less cash on its balance sheet. And you will have $10 million of cash in your brokerage account. So your net worth is $65 million, which is $55 million worth of Dave's Donuts and $10 million worth of cash. $65 the same as scenario A. Therefore, your net worth hasn't changed. You're still worth $65 million. Whether all $65 million is in Dave's Donuts or $55 million in Dave's Donuts and $10 million in cash on your brokerage account, it's the same. So that's the reason why dividends don't increase your net worth. They really don't make a difference. Let's review the second point. Dividends do matter to some investors. Even though they shouldn't make a difference, many people prefer investing in companies that have a history of paying dividends that grow year over year. Overall, these investors tend to get good results. In a previous video, we reviewed the example of my cousin Dave, who invested $30,000 in 6 dividend growth companies 20 years ago and now receives annual dividends of $16,000 a year. And his portfolio with dividends reinvested is now worth $408,000. Here's why dividends do matter. Number 1, dividends are a signal or a symptom of a good business because to pay out regular dividends, the business should be making money. If a business isn't profitable, it is hard to fake a dividend over a long period of time. Number 2, dividends keep management disciplined since they need to make sure that the business makes enough money to be able to pay out a dividend. 3, dividends provide money to spend. This is a good feature for people that are retired or in process of retiring. And number 4, dividends reduce stress since the investor doesn't have to depend on the price of the stock to sell to generate income. On a side note, you should know that dividends could be inconvenient to long-term investors because, number one, you will need to reinvest the dividends. And number two, dividends may be taxed less favorably than capital gains if the investment is not held in a tax-advantaged account like an IRA or 401k. By now, you probably realize that dividends are nice to have, but don't really matter. This takes us to point number three. What really matters? Profits do. The number we really care about is return on invested capital, or ROIC. This means the return you would get on profits that aren't distributed and stay invested in the business as retained earnings. Remember Dave's House of Donuts? Recall that each donut shop produced $200,000 in annual profits. This means that for each $1 million invested in a new shop, you get $200,000 of additional profits. That's a 20% ROIC, return on invested capital. If no dividends are paid, it will be like leaving the profits in the business and letting it grow at 20%. A rational investor faced with the option of leaving the profits in the business that could earn 20% return versus having to look for another place to reinvest the dividends will most likely prefer to leave the profits in the business and not receive a dividend. If it paid out dividends, he could opt to reinvest them back in the business or somewhere else. But finding another good business earning 20% ROIC might be challenging. On the other hand, if you are a dividend investor that lives off dividends and the company doesn't pay dividends, you could sell a percentage of your holdings to obtain cash. There you have it. For me, dividends don't matter. The number that really matters is return on invested capital, ROIC. If the return on invested capital is a decent number and holds in a steady range over time, I'd prefer not to receive dividends. Otherwise, if I did get the dividends, I would have to make some effort to reinvest them.